Welcome to Raise Your Average. I'm Joseph Lamena, Managing Director at AdvisorAnalyst.com. My co-hosts are Mike Philbrick and Adam Butler from Resolve Asset Management, SEZC. Our special guest is Ted Seides, founder of Capital Allocators, LLC. The Capital Allocators podcast, named one of the best investment podcasts with well over 5 million downloads. And most recently, the author of his second book, and now a bestseller by the same name, Capital Allocators, How the World's Elite Money Managers Lead and Invest.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Ted, welcome to Raise Your Average. It's great to have you.
Thanks, Joseph. Great to be here with you guys.
Good to have you back, Chad.
Yeah, Mike, I'm ready for the grilling. Let's have it.
I love it. In classic fashion, right? Raise Your Average is about, taking the advisors out there and raising their knowledge level and average when it comes to all things investing. And you have probably one of the best resumes in that world. I mean, even the name of your Capital Allocators podcast and the world's elite and the way they invest and manage their teams is stellar. And I think we probably should mark the beginning of this conversation with a small moment of silence for David Swensen. And what I was I don't know if I was enthused or tickled, I don't know if the right wording is, that he had done a lecture earlier last week with Yale in one of the management schools that he had been conducting with a colleague of his for 35 years, still was, even though battling cancer and things that I certainly didn't know about, was deeply committed to this endeavor.
For those who don't know, right, this is relevant because, Ted, you spent several years with David along your career trajectory, right? So it may be useful for you to sort of set the stage by telling us a little bit about your career trajectory, and then we can maybe pause with some anecdotes of your time with David, given the context, and
Sure. Yeah.
And go on from there.
So I graduated from Yale in 1992, and my very first job was working for David at the endowment. And I stayed for 5 years in that period of time. And so he was my first and really my true mentor in the business. He was an amazing leader, investor, teacher, mentor. He'd been sick for a long time, but it's very much like the way people describe how bubbles burst, right? Very slowly and then all of a sudden. So he had been sick for a while, but I don't think any of us were expecting this. Though there were a number of people who got to the point where they thought he was invincible. Because I think he had cancer, terminal cancer, for 9 years with a maximum expected life of 5. And just, like anecdotally, his wife and 2 stepkids got COVID and he didn't in the last, over the last year. So, very sad, but was coming. It was a long time coming. And he had just an amazing impact on people and the industry. So there's a fair amount getting written about him now, like certainly this week. I wrote a little piece that I sent out. I wrote a little reactionary piece and then a piece over the weekend. And there's really 2 sides of that. One is this incredible impact he had on the investing world because he popularized the institutional framework of multi-asset class investing in the particular way that he and only a few others had been doing it in a book he wrote 20 years ago that became kind of the seminal Bible for this group of investors. And then on the other side, on the interpersonal side, he just touched so many people. There were a number of my old colleagues who eventually left and now run other large nonprofit pools of capital. He and his longtime number 2, Dean Takahashi, taught this class at Yale for something like 35 years. It was a 20-person seminar, but you think about that, that's 700 Yale undergraduates many of whom went off into the investment business. And then they had this incredible portfolio of managers around the world that they just had amazing relationships with. So he was a very, very special guy. And it took some reflection for me over a couple of days. hit me a lot harder than I maybe anticipated it would, because for a whole bunch of reasons, but just the amazing impact he had on the trajectory of my life and my career. And then you see how common it was, and the things that you read about him now, the adjectives that people used to describe are just not common. Selfless and confident as it requires to be a great investor, how giving he was, how mission first he was, and really, in many people's eyes, foregoing insane amounts of compensation. I mean, they've run the numbers. He and the team added something like $35 billion of added value to Yale. So that's above peers, above benchmarks. We call it alpha over 30 years. And he was making a few $1,000,000 a year. At the end, when I worked there, he was making a few $100,000 a year, and he thought that was sufficient. So just a remarkable, kind of unparalleled person. Very sad.
Yeah, and I mean, his general framework is, would you say it's timeless? Sort of the way he thinks about allocating capital and the rules and heuristics that he applies to the selection and partnership with managers. How much of that experience with him have you sort of pulled forward into your own framework and informs what you describe in your podcast and in your book and what you use from day to day?
Yeah. I mean, most of what I learned from investing came from him. Those are the formative first 5 years of my career. He started kind of the investment challenge from what he always referred to as first principles. And that is broadly applicable, not necessarily exactly how he did it, but the concepts and how he applied them. So you're sitting at Yale, you have an endowment that has a perpetual time horizon and very limited liquidity needs. They have spending every year, but they also have donations on the other side. So liquidity needs are very, very light. And he walked into what was more or less a traditional 60-40 portfolio in the mid-'80s and said, this doesn't make any sense. So first principles, if you have that long duration liability, you might as well have long duration assets, and equities are the most long duration assets that exist. So very equity oriented. Within that, you want diversification because that's the ultimate free lunch. And then there were other first principles, things like looking for less efficient playing fields, alignment of interest between sort of the investor and the managers they employ. So there's some real basics there. And that sounds so common today. Some of the things that he said, but it wasn't when he started. And so what we all miss on the day-to-day, the year-to-year, is that he was constantly innovating on what those next 2 or 3 things to think about. So to give you a fun example, especially for you guys, in the early 90s when I was there, I was pretty focused on the U.S. equity portfolio, which was much more meaningful then than it is today for them. And David had looked at the Roger Ibbotson data of stocks, bonds, bills, and inflation, the book that he reprints and resells every single year with one extra line of data, and said, if you look at the growth of a dollar over long periods of time, what happens with cash? What happens with bonds? What happens with large cap stocks? What happens with small cap stocks? Sure looks like small cap stocks do better over a long period of time. So Yale's U.S. equity portfolio was always biased towards small cap. Similarly, value won over time. It was always biased towards value. That was before there were things called factors. He just looked at the academic research and said we should be biased towards small cap and value. Nobody talked about factors then. About 15, I have to think back, maybe it's close to 20 years ago now. I was out of the office, but I was having a conversation with him, and he said, we're just finding that our managers are all gravitating, and what's really working is these businesses that are just better businesses, and we've called it quality. And there was no academic research about a factor about quality, and they had tilted their portfolio towards quality stocks. And so who knows what those have been in the last couple of years, but he was always thinking from first principles and then implementing within that kind of broad asset class structure that people are more familiar with. But there were all kinds of kind of incremental opinions and innovations that happened within that.
Yeah, I kind of think of him as sort of one of the grandfathers, if you will, that if you look at other large asset endowments and you look at the lineage of where they come from, there's just his students.
Diaspora.
like litter the heads of these other endowments, much like the Bill Parcells and Bill Belichick, sort of through the football domain, where you have this sort of thought process of how you build a team or build things and go about allocating, if you will, is just become a pretty great training ground. And I think probably the whole endowment arena owes him a great debt of gratitude, actually.
Yeah, absolutely.
So how have you, in those formative years, how have those come along your career trajectory? Maybe step on from Yale and then go through your progression and ending up at Capital Allocators and give us your personal arc beyond the Yale experience.
Sure. Well, I'll go through the rapid highlights. I left after 5 years to go to business school, thinking I wanted to pick stocks. I did that for a little while. I wasn't sure that I was learning enough about business analysis, so I moved over to private equity and did that for about 2 years. And then I had decided that I wasn't really good at any of that, and I went back to picking managers, and that led to the formation of a partnership called Protégé Partners, where I was one of the founders and co-CIO for 14 years, investing in smaller hedge funds and seeding new hedge funds. And I left in 2015, so about 5-6 years ago. And did a whole bunch of things. I'd written my first book, which was a series of lessons and case studies, really, of seeing all these startup hedge funds. So both for managers who are going through that path and allocators who are thinking of investing in these smaller funds. And that led to being on a couple podcasts, which led to an idea of, hey, I want to just go run around and talk to my old friends and see what happens with that. So I did that on the side for a couple of years. I was, working with a family office and doing a couple other projects. And about, a year and a half, 2 years ago, I just kind of woke up one day and said, wow, the people are like now calling for adverts. Maybe this is a business. And so kind of leaned into it, and it's gone from there.
That's terrific. So how has your process evolved, or your thinking evolved over, and this may dovetail to how has the business itself evolved, and the managers and where edges might be found now versus, 10 or 15 years ago. But what are some ways that your thinking has evolved in the context of the way that markets have evolved, do you think?
Yeah. Well, markets are always evolving. One of the things I found from tried and true principles is that when you leave the nest, you try your own things. You try your own spin on things. And what I learned over and over and over again over the years was that David was always right. So I would come back to things like, market timing and say, I know he says that most of the time you can't really time markets and therefore you should just be diversified. But, I know when things are overpriced on the margin, and, I'd buy the Howard Marks view that you kind of know where you are in the cycle, and that just never works. So I've gotten more to an even deeper appreciation that I can't time markets. And it's when you believe that, it's amazing the kind of conversations you have with people. We say, yes, but, isn't Dogecoin ridiculous right now? Like, of course it's ridiculous, but that doesn't mean it's not going to go up further. Or we just don't know. So from a broad brush perspective, most of what I believe is very consistent with what I learned at Yale. But yes, markets evolve. And the biggest evolution today for pools of capital like that is that you can't look at asset class buckets, whatever you want, U.S. equities, international equities, emerging market equities, fixed income. You can't look at any bucket of asset classes and see an expected return anytime soon based on current pricing that will get people to their spending needs. So for institutions, that maybe, let's just simplify it and call it 5 to 8%. And that's a real challenge. Like, what do you do in that situation? And so you've seen shifts towards private equity, which is right, and depending on the rationale, it can either be right or just the assumption of more risk because you're not getting paid what you need to get paid to meet your spending needs. And so that's been the biggest shift, is that when I worked at Yale and most of the time since, the anchor of portfolio construction was tied to asset allocation. And the academic research about sort of cross-sectional returns of asset classes would have told you that asset allocation is what drives your returns. And that matters more. So the index fund movement, all these things, if you get asset allocation right, keep your costs low, you can get where you want to be. The problem with that today is that most of the most sophisticated people in the world don't think it'll work, because you can do asset allocation, you can have low costs the same way, but if the returns don't get you what you need for your spending, it's not enough. And so a lot of the most sophisticated institutions are moving away from asset classes as a driver of returns. They still use it as a communication tool because it's easy to understand, and moving more towards, you could call it opportunistic investing. Now that might not mean moving around asset classes. It might mean more focus on manager selection, less bounds of what asset classes are. So to give you one example, a number of years ago, Notre Dame had 6 asset classes. And you could, it's off the top of my head, I don't know, but you can imagine it's U.S. equities and private equity and venture capital and real estate and all that. Today they have 3, public, private, and opportunistic. Those 3 buckets don't tell you anything about the returns of what's in each bucket. So what they're doing is being driven entirely by manager selection. And then they'll take a top-down view after that and say, okay, what do we own? Does this have the kind of diversification we want? And they'll make changes accordingly. But they're not driving their implementation decisions starting with asset allocation and buckets to fill. It's all bottom up. So that's one big change. Another big change for these institutions is on the cost side, which is if returns are tighter, which means you really don't have as much, call it margin for safety relative to your liabilities, one way you could do it is squeeze out returns, or more of the net return. So you see more co-investing in private equity. You see more movement towards some internal management of the assets so that these pools of capital don't have to pay the extra layer fees to get at the underlying economics of what they're investing in. So there's a bunch of different changes along the way. But most of the seminal core principles that David espoused absolutely hold true and are somewhat timeless.
I'd love to chat more about, because it's such a great story about your experience with the bet with Buffett. Mm-hmm. And we've obviously written on that and are big admirers of your the motivation for that bet and the way you approached it. But maybe if you don't mind, just give us a little background on how that came about. What was it and what was your experience with it?
Yeah, sure. So Adam, you know this well, but so we have to go back to 2007. So Warren had made some statement really to the effect that costs are expensive. And he made a statement that a group of hedge funds couldn't beat the S&P 500, kind of a broad statement. I thought that was cheeky, and I thought it was mostly wrong. And there's a lot of reasons why. But the easiest ones are that it's very apples and oranges comparison. So a group of hedge funds, so the argument that fees eat up returns is a true statement in a constrained market where the participants create the market. So you can imagine if your only mandate is large cap stocks, and you put 25 different managers that collectively own 2,000 securities together, they will probably own the market and you're paying them fees, so you lose. And that's kind of the argument. If you broaden it out, you could say, yeah, the more you pay, the riskier it is that you'll get attractive returns. The problem is that hedge funds are totally different. And hedge funds can invest in Asia. They can invest in cat bonds. They can invest in all kinds of things that have no relationship to the S&P 500. So when I looked at that back in 2007, the S&P was trading at all-time high multiples. So just U.S. stocks alone would tell you, roughly speaking, there's an inverse correlation with starting valuation and subsequent returns, particularly over long periods of time. And if you're starting with a high valuation, that means you're likely to get a subpar outcome. And let's just say that's subpar relative to average over history. So that's kind of interesting, right? At the time, short-term interest rates were, 4% or so. So unlike today, where you say, well, interest rates are so low, that justifies a higher multiple, there was nothing about rates that would have told you that it justified a higher multiple. So it felt like U.S. stocks were priced expensively. And then you look at these two things, and you say, well, hedge funds historically tried to seek equity-like returns. So the outcome, the expected returns, the outcomes of the two buckets are the same, but they were trying to do it in a very different way. And so if you started and say, oh, do you want to bet on the S&P 500 at that point in time? My view was, well, no, it's too expensive. This is the wrong time to be making that bet. And you could imagine 3 different scenarios over those subsequent 10 years. If stocks are expensive as they were, you might have expected a subpar return. Maybe valuation multiples don't change and you get that historically average return, right? Or maybe multiples somehow expand from there and you'd expect to get a better than average return. Well, on the hedge fund side of that ledger, none of that really mattered that much. You sort of expected that hedge funds were going to earn around that historical average return. So I looked at that bet and said, didn't matter if it was Warren or anyone else, I would looked at that bet and said, well, that sounds like a pretty good bet for hedge funds, because I thought that the S&P 500 would have a subpar return, and you'd want to bet on almost anything except for that if, stocks weren't going to generate good returns. Well, it sure looked good, because the bet started in January 1, 2008. The market collapsed, and I don't know the exact numbers, but after about 14 months, hedge funds were about 50% ahead of the S&P. Up until that starting point in time, if you look back 15 or 20 years, wherever there was real data, the gap between hedge funds and the market was never more than 2% a year in any given year. So it looked like the bet was over 14 months in, based on history. Then there's, the Fed came in. You never know what's going to happen in markets. And I don't know that there was another quarter in the next kind of 8 3/4 years where hedge funds beat the market. And sure enough, after maybe 6 years, the market caught up and surpassed hedge funds, and then Warren won the bet.
So there's two elements to that, right? One was that markets went on to deliver on scenario 3, right? Where not only did they preserve their prior valuation, but they went on to achieve even higher valuations relative to earnings and sales, right? So they had this sort of outlier outcome or improbable outcome relative to history. And hedge funds maybe didn't quite deliver they deliver sort of below average performance over that time period. But I think, and I've heard you reflect on this subsequently, that if you had your time back, you might have run the bet a little differently. So maybe what lessons did you learn after the fact that you might have brought to another bet like that going forward?
Well, the biggest lesson I took away from it is you really don't, this is back to what I said about market timing, you really don't know what will happen, even if you think you do. So this is a classic kind of probabilistic outlook on markets. This bet played out, and there was only one outcome, which actually tells you nothing about the probability distribution of potential outcomes from that scenario. There's only one outcome, and that one was a losing one. That wasn't new to me, but it's sort of, an interesting thing. I had written a paper at the beginning of the bet that effectively was my thesis for taking it. So you could actually go back without bias and read that. And what I would say from it was I was a little too optimistic about hedge funds. And I think more than anything else, at what point in time you'd hit this inflection point of competition really making returns difficult to come by. And I do think that happened sometime in that period of time. And, there were a bunch of other things. You could have changed the bet to make it a little more apples to apples. That wasn't a lesson, I would say, but that was certainly something you could have done. But what I've told people is, look, Warren Buffett makes a proposition. You either take him up on it or you don't, but you don't get to change the rules.
Right, fair enough.
So those were his rules. I thought it was a winning bet with his rules, and I was happy to take it. In fact, I made it even harder because in theory, we could have picked, say, 10 hedge funds, and we implemented it as 5 fund of funds, which logistically, there were some reasons to do it that way to make it easier, but it also added a layer of fees. And part of the reason I wanted to do that was I said I was so confident that we would win the bet, that you could say, well, those 3 hedge funds did unusually well. Well, if you had 5 fund of funds and you beat the market, then what was Warren going to say? And what was interesting is we actually know what he was going to say, because in after the second year of the bet, he also had experienced the first time where the S&P had beaten Berkshire Hathaway over a 10-year period. And he had a quote, which I then pulled out and had in a presentation that I'd give to our clients about the bet, because everyone was asking, which effectively said, even in time periods as long as 10 years, the results can be significantly influenced by the starting or ending points. So we actually know, there's a big investment lesson there that whatever you think the long term is, I've said the long term is really 3 to 5 years. And any investment strategy, any investment with a manager, your assessment of the success of that investment will be significantly influenced by the time period that you happen to choose.
Most definitely, yes.
Yeah.
And I think you also commented, and we definitely picked up the torch on this, and graciously, you're, and this is absolutely right. You don't get to reset the terms when Warren Buffett designs a bet, right? But in all fairness, you were pitting an asset class with an expected vol of 4 or 5 against an asset class with a vol of 16 to 20. So, in all fairness, maybe a comparison on risk-adjusted returns would have been less biased, but you don't get to set the terms, and you took the bet you did. But yeah. I think it's also a good lesson that it's even harder to deliver higher total returns when you start with a major handicap of also having an investment with much lower risk. So the apples to apples there would be to square up the risk so that at least you're competing on an equal footing. But anyways, I thought it was a great bet, and we obviously wrote some complimentary views on that after the fact. And you're right, resulting here is not very fruitful, but great. So anyways, you left Protégé Partners and you started this. Essentially, you went right from Protégé Partners to this podcast, the Capital Allocators project being your full-time effort, right? And then you I guess had enough interviews under your belt and had taken enough notes and were able to distill the lessons from those interviews that it eventually motivated the writing of this book, right? So walk me through that process and what the book's about.
Yeah. I mean, there's always a book in a podcast. I think by the time I put the pen to paper, so to speak, there were something like 3,500 pages of transcripts. So it's not a question of whether there was a book. It was sort of what and whether I wanted to do it. What happened for me was after probably 40 or 50 episodes, I had started to forget the little nuggets that I was getting from each one. You just couldn't keep track of them after a while. And I decided that I wanted to go back and, for my own investing benefit, just have access to the things that I thought were the most influential learnings for me on my desk. Because once you write a book, you realize that the bucket list has been checked. And there's not a whole lot of reason to spend the time and energy to write another one because it does just suck up time and resources. And so that was never going to be the motivating factor. For me, the motivating factor was really, I wrote it for myself. I wanted to go back and make sure I was learning from all these conversations and not just kind of producing stuff. So that started with probably the areas that I learned the most, which were the non-investment areas. And the way I think about it is that because we're in this environment and have been for a while and probably will be for a while longer, where this, call it margin of safety or the expected returns over what people need to meet their spending needs is much narrower than it was in the past. That means that all of the things we know that go into the investment process to generate those returns have fewer degrees of freedom to get wrong. So things like decision-making theory, how do you go through making a sound decision? Things like leading a team and managing a team and getting things done are all things that just happen to be fascinating to me personally. And I knew that they weren't things I had been taught in my 25 years of investing. And so I was able to have some of those people on the show or, pick out some people that were great in each of those fields and pull out those lessons and share those as this isn't definitive research on any of these topics, but it is a distillation of the 4 or 5 conversations with, say, the best business leaders that I've interviewed. And what do they say about what it takes to lead an organization? You create a framework out of that and just share that framework. And so that was what started it. Then there was another section, obviously, from these conversations of how has this, call it endowment model, evolved? So what's changed? What are the challenges? How have people evolved it and why? And so I created kind of an investment section. Part of that investment section was what I like to say is sort of the part of David Swensen's book that he didn't write. So in Pioneering Portfolio Management, David wrote beautifully this whole thesis of what this strategy is about. He didn't say a whole lot about how they go about doing it, like what actually happens in the investment office. Where do they find their manager ideas? How do they conduct their due diligence and research? How do they construct their portfolio? So I kind of walked through that process, which is more of my experience both at Yale and since, and than it is necessarily from the podcast, but a little bit of both. And then when I did that, what was left was lots and lots of these great little nuggets that didn't necessarily fit into one or the other of those sections. And when I went about writing the book to distill those old lessons, I had a team go back and outline every single episode through quotes. So we cut it at 150. So there are 150 episodes. And we had a list of 40 or 50 quotes that outlined every single one. And I went through all those, and that's where I started picking out the themes to write about. And at the end, we just took the best ones and said, there's like 160 left. Let's categorize those and just share. This isn't what I think, this is what the guest said. And that's one of the most fun kind of areas and compilations of the book. So that's kind of the 3 sections of the book. I have a couple copies right behind me, and there literally isn't a day that goes by where I'm not opening it up to refer to something or find something. It helps that I know what's in there and I know where to look, but it really has become kind of that manual for me. And it's gotten, I've started to hear really great things about people who have had time to read it since it came out about a month ago.
Yeah, I would agree. I thought that you separated into sort of the toolkit, the investment framework, and then those nuggets of wisdom. And I found that first part really interesting. The idea before you get to the investment framework, there is a whole myriad of steps that need to be thought about from, as you mentioned, decision making and negotiation and leadership and these things, which were, I think, critical to the investment process, but are often sort of left off or not discussed so thoroughly. And then the nuggets are just magic. I mean, that's
one of the things that I was really impressed with, and I don't think get nearly enough attention, is the importance of all of these many qualitative or sort of softer skills, and sort of looking around corners that makes all the difference in manager selection. So I wonder if you could go into some of your thinking on that, because I think that the level of detail and rigor that goes into top quality manager selection and due diligence would surprise a lot of people.
Yeah. Well, that whole process really is the most people-oriented side of the investment business. Because if you think about the difference between picking a manager and investing in a company, on the manager side, there's much less data. You don't have 3 sets of financial statements. You really just have a performance track record and maybe a little bit of exposure and maybe some positions underneath it. So there's work you can do, but ultimately you're trying to assess how is this person and team likely to perform going forward. And the methodology for doing that does have similarities, which is if you go meet an investment manager for the first time, you'll probably be excited and blown away, and that'll probably happen the second and the third and the 10th and the 20th and the 30th and maybe the 50th. But when you get to the 200th, you'll start to realize, ooh, that first guy I met, they weren't all that interesting, and you can start to explain why. Now do that in the thousands, and you develop a whole set of pattern recognition that really goes into, you could frame it, people talk about people, process, and performance. 3 Ps. I use 3 Cs, character, and character. There are all these kind of cute alliterations. But ultimately what you're trying to do is you're trying to understand very deeply, how does that investment manager think? What do they believe about investing? Why is the strategy they're pursuing likely to work? So from a philosophical perspective. And then you walk through their investment strategy, which is where do they get their ideas? How do they conduct their research? How do they get from there to a decision? How do they put that decision in the context of a portfolio? How do they think about managing risk? Fairly straightforward an investment process. And then as you ask questions about each of those things, you're always reflecting back on, does this fit into that strategy? And that's kind of the process part of the equation. Then you have a team of people. And you have to figure out, okay, There's also an element of, do you like that strategy, which has to do with your own beliefs as an investor. So I'm bringing to the table my own set of beliefs, and I'm meeting with a manager. Does that fit into my set of beliefs about what works? But then I have to say, okay, I'm meeting with Resolve. I think these guys are really smart. They seem nice. There's also 50 competitors that are doing the same thing. And let me go meet with 20 of those that I've heard are the best and try to figure out what are the subtle differences about one manager from the next. And you just iterate on that over and over and over again. Then you bring it into your team and you go through the whole exercise that everybody else does. How do you make a good decision as a team? Let's get other people's opinions. And then when you really think you have it and you've written it all on paper, you then bring it to an investment committee who might be the ultimate decision maker. And you have to convince them that this is something that fits into the portfolio. So there's a lot, and that's at the manager level, right? Then it rolls up into a portfolio level, which is the stuff we were talking about before. So there is a lot that goes into it. There's some combination of science and art for everyone. And then every allocator has their own views and their own way about going about doing it. So there isn't a right answer for sure. But there is a lot that goes into it.
So say more about the character, because you've shared a few stories in other conversations where, for example, it's just so important to check references, or it's great to meet with employees who have left the firm. These types of sort of the type of due diligence that goes maybe further than many classic allocators might think to go. So any thoughts in that regard would be interesting.
Yeah, sure. There's a lot, but there's two different ways I would think about framing it. One is, what's the purpose of doing all of this work on this people assessment? And I would say that what you're trying to do is figure out if what you heard and saw in terms of the investment strategy and the limited number of examples that you may have walked through is true. If what you believe about that person, is it true? And that's very difficult. A good friend of mine, Graham Duncan, just wrote a wonderful blog piece about this. I think it's grahamduncan.blog that talks about, what's in front of you? Who is this person? And how do you figure out who they are? Because, by the way, they don't necessarily see themselves clearly for what they are, and you don't see yourself clearly. And so how are you trying to figure out what's real? So there's a real psychological piece almost of trying to figure out, what's real. The other thing I would say is that what you're trying to do within the context of a strategy that's a little bit, less at the high psychological level is you're trying to understand if the manager has your interests at heart. Because the structure of most of these relationships and the compensation is such that the incentives aren't usually perfectly aligned. If you look at asset management businesses and fees, most people actually do better just raising more and more money than they do limiting the capital but performing better. So that's kind of a truth across most of the industry. It's not right in the sense that it probably shouldn't be set up that way, but that's just how it is. And so what you're looking for is a manager who deeply understands and appreciates that it's not their money, it's your money, and they're trying to do right by that. And so what I found over the years that's hard is that the only time you really figure that out are during periods of exceptionally good performance and exceptionally bad performance. And when those happen and people are under, in the latter case, stress, and in the first case, greed, you get a chance, or you could say fear and greed, you get a chance to see how they respond. And sometimes you can do that in advance of investing, and sometimes it happens concurrent. And what you find is that over long periods of time, the people who are really in it for the game itself and not for their own balance sheet tend to be a little less temperamentally volatile in those periods of times. And that's kind of what you're looking for.
What were some of the common threads you discovered among all of the different capital allocators?
Wow. So there are a couple of things that are super interesting. So one is that this was a relatively new field call it, even when I started, it was brand new. There were very, very few of these offices, which means that if you interview CIOs today, they all come from wildly different backgrounds, which is kind of fascinating because there was no linear background to get to these seats. What I find even more interesting is that's actually now changing because these organizations have been around. The people who are getting elevated are more and more square pegs in square holes, right? The number 2 at another endowment becomes the number 1. A CIO at a smaller endowment becomes a CIO at a bigger endowment. That's not necessarily good or bad, but you do start to ask questions of where will innovation come from now that we no longer have Dave Swensen, if people are linearly ascending into roles, maybe even getting to a Peter Principle type issue. So that's one that's super interesting, that these people just historically have come from wildly different backgrounds with all kinds of different perspectives. And that brings that power of, cognitive diversity across the industry. The other I would say is that governance, and I would define governance by ultimate investment decision making. So can the CIO implement the strategy they think that they would like to, is far more challenging than I had appreciated. So with the exception of some of the top endowments with people who have been in their seats for a long time, you see a fair amount of CIO turnover. You see board level turnover. You see boards that are not sophisticated investors. And when you do have people that have been around some of those more challenged governance organizations for a long time, so take like a Chris Ailman at Cal Stirs. Chris says his job is a teacher. It's as if he's teaching Investing 101 every other year, because he has new board members coming in that all come from outside the industry, and he has to reiterate the same thing over and over. He has to re-educate those people. And that's particularly hard because all of the challenges of behavioral bias that people in the industry have learned about over the last 5 or 10 years and tried to figure out how to address, if those are brand new to the person who's ultimately making the decisions, boy, they've got a lot to learn. And it makes it very, very difficult for those organizations to make effective investment decisions when they're so far behind in terms of the underlying foundational education you would like to have before you're tasked with making investment decisions. So that's the second one, that big governance challenge. And then the third is this idea that everyone's looking for the next thing. Everyone is looking for the next opportunity to add alpha, and most of the time you don't see it. But when it comes up, it's this sort of eye-opening. There's this wonderful piece written in the last couple of weeks about Tiger Global by another venture capitalist from Founders Fund that talked about this hedge fund firm in the technology space who found this niche in this kind of like later stage private investing. And they used hedge fund type research and effectively hedge fund ownership principles to apply it to venture capital. And they found that, historically venture capital firms took great pride in being on the boards. And they said, well, we're not going to be on the boards. We're going to be good at making fast decisions. And we're growth investors. So we're not going to worry as much about price. And they carved out a very, very successful niche. But that is something that just doesn't happen that often. But people look all the time. And I had a business school professor who runs High Vista Strategies and outsourced CIO, named Andre Perel, the brilliant guy, who said, alpha just isn't sitting there waiting for you on the corner of 47th Street and 5th Avenue. You have to go dig for it.
Right. Got to work for it. It's usually harder than what everybody else is doing.
And less comfortable.
Yeah.
So what are, obviously you had a chance to interview such a broad group of allocators that were very different in many cases along different continuums. What ones really stood out to you in terms of the way they viewed the problem, the way that they structured their organization, the type of managers or investment strategies that they were focused on? Anything really, what were the outliers? Any come to mind?
They all are and none of them are to some extent. So what I would say is that most of the successful people in the seats are a function of the pool of capital they manage. So you could look at a series of endowment CIOs and they have more in common than a series of pension fund CIOs because the nature of the asset and liability structure is just different. And that would be different yet again if you were interviewing a bunch of financial advisors, where the spending needs of individuals are just a different set of criteria than they would be for either of those other pools. And so there aren't that many people that think wildly differently. I think that, like anything else, there are a set of principles, and David Swensen was probably the first person to publicly espouse these in a way that others could understand. But there are a set of principles that generally work, and you can veer from them, but that's not what people veer from. When people talk about the risk of being different, they're trying to find things that make sense that might be a little bit different from others. And generally speaking, the structure of the investing isn't one of them. It can be on the margin, but it's do you want to invest in managers? Do you want to do it yourself? Do you want to have, everyone wants lower fees. How are you going to access lower fees? Are you going to be about access? Or are you going to be about, finding someone who's off the radar? If they're off the radar, are you making sure that they're off the radar because other people haven't found them, or because you missed something and they didn't miss it? So there's a lot that goes into all of those, but I don't think there's so many little, part of that, as Mike said, that nuggets of wisdom section, there's so many little sort of special things that people talk about that frame the investment challenge that's much more impactful when you add all those up than any one person says, well, that person is so different from others.
So because this podcast is directed to advisors, and I'm just wondering whether there are any particular lessons that can be distilled from conversations with the really big allocators. They obviously these big allocators have many advantages that an individual advisor may not. Does an individual advisor have any advantages that they might want to put to use, and how can they put those to use in the most effective way?
Yeah. The good news is I would not generalize by saying advisors have advantages in the same way I wouldn't by, endowments have an advantage or pension funds have an advantage. I wrote a piece a couple of years ago about home field advantage, and it came from a woman, Ellen Ellison, who was a guest on the show, who managed the University of Illinois endowment, and it was called the Illinois Foundation. And because of where they sat, they invested a lot in agriculture because they had people around them who deeply understood that space, and they felt like they had an edge. You have others like University of Virginia, where Julian Robertson was a graduate, and lots of graduates happen to be long-short equity world. And if you looked at the University of Virginia's endowment, there's a lot of long-short equity managers because they understand and know that ecosystem. So for financial advisors, the biggest benefit that financial advisors have that most of these pools don't is their client base. So their client base came to them because they're super interesting, oftentimes wealthy people who have succeeded in something. And the question will be, how do you mine the very specific knowledge in the client base to improve investment results? And that might be one-off opportunities that other people don't have access to, where you can sort of say, look, you have a particular client or set of clients that knows something about a particular industry. It's not about asset allocation. It's not about U.S. equities. It's about this particular technology entrepreneur who understands software and is telling me, hey, this is an interesting space. And then you can corroborate that. So that's one advantage. The other is actually a huge advantage, and this is a little more structural, and something it took me a while to appreciate, which is that great financial advisors are able to add a lot more value to their clients than just the investment results. Great endowment and pension fund managers are entirely beholden to solely the investment results, which means that if you take the same principles of investing that we all believe about the importance of having a good long-term strategic allocation, sticking to it through tough times, the financial advisors have the ability to keep their clients calmer. Not easy, by the way. Clients aren't necessarily calm, but they do have the ability to add value and not risk losing their clients only because of market-related returns. And that's a massive advantage if they then take that and apply it to their investing.
It's a tough one, though. I mean, you've got, as you mentioned earlier, you've got the CIO who's responsible for communicating both up and down the chain of command. and then keeping that consistent across multiple generations. David Swensen, again, will come back as the example for someone who was in the seat for 3 or 4 decades. And you don't see that level of consistency across so many other large endowment and pension funds, which is a real challenge. How are you, if you set out as the sort of permanent capital, set out with the permanent capital view, but you have transient managers and board members of that permanent capital, it is a really hard equation to solve. It's something I think that David wrote about in his books too, about actually managing the board and doing a very good job at selecting who was going to come on to the board in order to maintain that level of discipline across decades.
Yeah. So I would say, don't get me wrong, none of this is easy.
Yeah.
This isn't like, all financial advisors have to do is keep their clients calm. You're in great shape, right? It's incredibly difficult. But across these different pools of capital, I would tell you that having the ability to add value beyond the investment-related results so that the risk of that client leaving is less is hugely, hugely important. And so what I've seen in great financial advisors is they do both really well. Like they're quite good in the investing, but they're incredibly good at the client service side.
So I think groupthink is an interesting challenge in, obviously in the institutional space and in the retail advisor space. There's a certain amount of groupthink that is a function of just the fact that there are genuinely best practices, right? As you say, sort of oftentimes you've tried to sort of deviate or experiment with new practices. And in most cases, you realize that those basic ones that David espoused ended up being most effective. Too much of that means that everybody is making the same decisions at the same time for the same reason. And obviously in investing, the best value and the highest expected returns are often found where others either don't want to look or are constrained in some way from looking. How does an allocator, whether it's an advisor or the head of a family office or an institution, a CIO, how should they think about balancing off this best practice, maybe leading to groupthink, against the fact that the best returns are found where most others aren't looking?
I'm all ears, Adam. I'm all ears. I mean, that is, that's the key question, right? There's no easy answer to that. A lot of it has to do with not when do you decide to go out on a limb, but what's the process? How are you communicating so that when you decide to take that risk, that everybody understands what that risk is and that it may or may not work out?
Maybe touch on some of the decision-making tricks and sort of lessons that you talked about in the book, because I think those are helpful. Yeah.
So decision-making theory really comes from a couple of guests that I know you guys know well too, Annie Duke and Michael Mauboussin. And some of the specifics have to do with group decision-making. So it starts with this idea that each of us as individuals are kind of hardwired to make bad decisions, which comes from way back in survival in the wild and fight or flight response. But the idea is that we'd like to think when somebody says something, we think about whether we think it's true and then we sort of respond accordingly. But that's actually not how the brain works. That somebody says something, you think it's true, and you're kind of lazy, and maybe later you decide, whether it's true or not. And that, runs into all kinds of issues. So it's hard for individuals to get to making good decisions. It's even harder for groups. So in some of the groups, there are certain things about practices, about how you form a group. And that can be true even if you're on your own, which is the ideal size for group decision-making is about 4 to 6 people. And the reason for that is that you want to be able to encourage other people to share their different perspectives so that no individual has to be beholden to knowing everything about every decision and weighing everything accordingly. And so you have a couple of different people. It doesn't mean they have to be on your team. They could be trusted advisors. They could be friends, whatever it is. But you want to encourage in any decision you're making to have a couple of people that have input. within that, and this is especially true if you do have a team, you want those opinions to come out. So it's not just that they're there, it's that those people are encouraged to express, you could say, disagreement or dissenting views, because that will make your sort of your decision process more robust. And so there are a couple things that go into that. One is, particularly if it's a junior person, they have to feel safe to express their views. Right? Sometimes you're in these situations where the leader is a very strong-willed person, and somebody disagrees with them, and they're like, "Well, that's stupid," and then they dock their bonus, and that person is unlikely to come back and say something that might be the key risk in a situation that other people have missed. So that's the words people use for that is cognitive safety. So the idea that you're safe to express your own cognitive expressions. There's a couple other things. I mean, Annie talks about thinking in probabilities as opposed to absolutes. And that's an incredibly important thing, particularly when you have a leader and the rest of the people on the team, because we now know that if the leader expresses a view, everyone else will instinctively just agree with their view. And that's particularly important because they want to curry favor to them so they get the good bonus, right? So now, one way that the leader can encourage people to understand that they don't have the answer is by saying, well, I'm about 60% sure of whatever they're saying, or I'm 70% sure of this. And if they think in probabilities, that allows other people to say, oh, they're not sure about that. Well, let me try to help them think about why that 70% might be 80%, or, that 30% seems kind of, let me tell them why I think that 30% is, really more like 40 or 50. And so when you think and talk in probabilities, it reduces some of that kind of absolute thinking, and that's kind of falling in line with other people. And there's a couple other little principles as well, but that's a lot of it. A lot of it is this deep understanding that when we talk, we infect other people with our beliefs. And that can be used both ways, right? There are times where you don't want other people's opinion, and so you can approach a situation, and maybe it's with your kids or something like that, and just say, "Hey, this is what I think, and what do you think?" And you're more likely to get people falling into line.
I think you also mentioned a story too about one of the firms actually hardwired it in so they couldn't actually make quick decisions. I'm going from memory.
Yeah, there's all kinds of ways of creating tools. So the thing to remember is, even once you're exposed to all of these lessons about how we're, our brains are kind of wired the wrong way to make decisions, it doesn't mean you get any better at it. Right. Because if your wiring is one way, you don't rewire it by learning that your wiring is off. It's still off. So what good investment organizations do is they create processes to mitigate some of those biases. So one is that, like, slowing down the decision. Say we have a decision. Let's not make a reactive, instinctive decision. Let's make sure we go through a process where we're in a room of people, and in that room, the most junior person is going to express their view first, or the least knowledgeable person is going to express their view first, and we're going to walk their way up. So there's all kinds of different ways that some of the organizations can try to make better decisions. Big one, by the way, is writing it down. You need to write down what you were thinking at the time, because there's this whole thing called hindsight bias, where we believe, you mentioned resulting earlier, at the end of a decision, if it worked out, we generally think it was a good decision. And if it didn't work out, we think it was a bad decision. And if we then say, well, it worked out, it must have been a good decision, let me write down what I was thinking at the time, we'll misremember the details so that it makes it look like it was a good process. So it's actually really important. Good decision makers keep journals while they're making the decisions. You could go back and review, why did I invest in that manager? Why did I pick that stock? And you could look at it and say, oh, this was right, this was wrong. What did I get wrong? Could I have gotten more information that would have informed that led to a bad outcome? So there's all kinds of little things like that.
Ted, what's the most important lesson you learned in all of your experience?
If there's one, and again, this is another one that David said to me at the very beginning of my career, it is the importance of being around great people. That the people you're around really do influence what happens both in your outcomes and in your life. And I've experienced a range of that. I've had, when my time at Yale, I was surrounded by fabulous people. Some of the leaders you guys had mentioned that are now running other things were colleagues. And when you're around people that you really enjoy and really respect, you get a lot better outcomes than when that's mixed.
What's the next project?
We've got 4 pillars going right now. I'm happy to walk you through them. So the podcast itself has become a business, and really, advertising sponsors, and we do some premium content. And so then the question becomes, if that's an asset, how do you monetize the value of that asset, which is really a data analysis exercise. So we're in the process of ripping out the back end of our website so we can track things like engagement with the site and, what people are reading and surveys and things like that. So that's going to be a fun project of taking this little cute thing on the side and saying, if this is a business, how would we treat this as a package? We are also starting a online training program for kind of mid-career allocators called Capital Allocators University. We're going to do the first cohort in September. Bunch of Annie's going to come teach. I'll be teaching, and that's going to be a lot of fun. And we're in the process of starting a second podcast, which is it's a unique twist on helping managers tell their story in a way that is, I think, part of what's made Capital Allocators work as a podcast, but that people aren't really well positioned to pull off, but our team is. And then the last is I'm going to be getting back into the investment business relatively soon. So I've been investing my own capital, and a combination of what I've done in the past and the relationships that come up from the podcast. And frankly, I'm running out of my own willingness to invest in illiquid things. So we're putting something together so some of my friends can invest alongside. Not unlikely to be anything like the institutional capital I ran in the past, but it'll be a lot of fun.
So you're running out of motivation to invest in illiquid things. So you're going to be focused on liquid markets or liquid strategies?
No, the opposite. Not motivation, money. I'm running out of money that I'm willing to put in things that I'm not going to see for a long time.
Gotcha.
Motivation is very high. The balance sheet's pretty fully deployed.
Yeah. So that sparks another interesting question. Is there any point in the process where things diverge a little bit for managers that invest in illiquid strategies versus liquid market type strategies? Any come to mind there?
Tremendous differences. I think one of the key differences between public and private markets is information. You have far more information available to you in the private markets. And so that means there's more work you can do. And that's both true if you're investing in a private equity fund, where there's a lot of data available about what's happened with each of their investments in the past. How did it transpire? What was their thesis ahead of time? Can you corroborate that? And there's also, I'll tell you a fun story. So I invested in a late stage private alongside a manager I've known for a long time and respected a couple months ago, maybe it was last year. And it was in the technology space. It's not something I know intimately. And I called a friend who's in the public markets in that space, and we started talking about, how should I even think about this? Like, I'm being told it's a good opportunity. I'm not going to spend the time to underwrite the company. And he said, I don't know, let's look at the board. So we go online and we look at the board members, and lo and behold, I knew one of the board members. So I called her up. It was an old friend I hadn't talked to in a while. And I said, hey, I have this opportunity. What's going on? And she proceeded to talk to me for 45 minutes and told me absolutely everything about the company. What was happening now, what the numbers were, what the projections were, where the CEO is having success. And you get off the call and say, that sounded like inside information. And it was, but it's a private company.
Right.
So there's a lot more to that. And then I would say the biggest difference from what I did in the past and what I'm looking to do now is it takes a long time in the business to really get to the point where, I refer to as sort of that deep authenticity of who are you, what is your edge, and how do you want to implement that? And for most of my career, I followed what I learned from Dave and implemented that in the hedge fund space, which was its own box. And what I found is that while the research that goes into that is something I'd want to replicate, my real advantage is in this area that I call compounding relationships. So it's relationships with managers that's not transactional. It's not, hey, this is a great fund, I'm going to give them money and be very, very passive. It's, is there a relationship here where I can give them money and find a way to add value to their business, to their investments, to their fund, and focusing on those types of relationships rather than trying to sharpen my pencil as tight as I can to say, here's 5 managers that all seem good. Let me try to figure out who the very, very best is. What I found is that my ability to add value comes from that relationship component, and that when I focus on that, the returns have taken care of themselves. And so, we'll have a team that's doing all the work that I used to do, but I'm focusing my energies more on making sure it's the right type of partnerships that are, adding value and compounding, the value of that relationship over time and letting it compound just like compounding capital does.
Yeah, that's, it just what you had said earlier about the private equity space. We had Arthur Salazar on from in Canada. I think it's Northland Family Office. And basically he mentioned the same thing. You're in private equity space where what you might think is insider information, hand quotes, is not illegal. In fact, it is the alpha. It is the sauce. It is the extra insights that you can garner freely because it's non-public markets, and you sign NDAs in order to hive off any of that in some cases. But you are literally seeking those types of insights and are able to do so. And it is an advantage. I think for certain people in certain situations, it's an advantage. You also have to consider that where are you in the lineup of people that might even get access to it in the first place, which is, it can be another sort of very, very large challenge. But it's an interesting feature of that private equity space.
So I'm going to let you go soon, but before I do, you've seen thousands of manager pitches, and we've spent most of the conversation on how to become a better allocator. How can managers do a better job communicating the merits of their strategies?
It's not an easy thing to do, right? Because people in my seat have seen thousands of these things over time. I try to communicate some of that in my first book, certainly for the hedge fund space. I think that if there's a way I could describe it, it's get feedback. Find ways to get feedback on presentation style, on clarity of the message. It's not easy to get feedback, generally speaking. You go out and you have these meetings and people invest, they don't invest. It's not very easy to do it. But people don't actually spend much time on things like their own presentation style. They don't often come out of meetings and say, how did I do in that meeting? They tend to come out and say, hey, did they that was a great meeting. They liked us. What are we going to do next? So there is this sort of create self-feedback loops because there's no silver bullet, right? Some people have the gift for gab and others don't. And there's so many managers. I think I kind of calculated or added up the numbers in this book. And I used some data from NEPC, and there are so many managers across strategies, across asset classes, that the chance of someone getting a meeting, generally think about it with somebody they don't know, is something like 5 or 6 times harder than it is for a college senior to get into Yale or Harvard. So it's a very difficult game to crack into and to keep going because there's so much competition and there's so many products that are more or less the same. So that means that the way to get reps and to make them better is just to get better and better at telling your own story.
Which is also so difficult too, because you're trying to get feedback and then you don't know the feedback that really worked well, but did it work well for the people you were presenting it to, or who is giving you was it your colleagues?
Does it generalize?
It just
hard.
It's hard as you say. Everything is difficult, but in searching for that, maybe you can find some nuggets. But it's definitely a good process, but a difficult one.
Yeah.
Now, before we let you go, I also wouldn't mind hearing a couple of those nuggets at the end of the book that were your favorites. Maybe that will entice people to actually also jump in, and the book is definitely worth a read if you haven't read it. I would highly recommend this book for your consumption. But there are a myriad of these sort of nuggets, as they're called. But I would love to leave folks with one or two that you liked, and then make them buy the book for the others.
Sure. Well, at the end, I put, after the compilation of the book itself, and I'll give a little pitch for something free. So in the process of writing the book, one of the things we did was we pulled out the 4 or 5 best quotes from every single episode. And we didn't end up using that in the writing of the book, but I did compile it, and I make it available for free to anyone who signs up for our mailing list. So that's pretty cool. They can go to capitalallocators.com, and that's got all of them in there, sorted by the guests. At the end of the book, I created a top 10 list. So there's, 3,500 pages of transcripts. There were 800 and something quotes, something like that went into it, and picked out 10. And they were, I don't know how you do that, other than they were the 10 that just seemed to resonate the most for me. So I'll tell one funny one and one kind of thoughtful one. So the funny one has to do with a friend of mine, Jim Dunn, who manages Wake Forest University's endowment in an outsourced CIO called Verger Capital. And before that, he was the head of research for the giant consultant Wilshire Associates. And he told this story of sort of one of the most clever ways that someone got in the door. So just this question. And he opened a box that came in the mail, and it had one red stiletto. And there was a note inside it that said, "I got my foot in the door. Can I come get my shoe?"
So good.
And he did end up taking the meeting. I don't think it went anywhere, but there are, I think on that list, one of my favorite quotes, and it kind of goes to what we were saying about decision making, comes from James Aitken, who's a macro strategist in Wimbledon, England. And he says, "Emphasize the reflective over the reactive."
Oh yeah, process that.
So I'll leave you with that one. That's
going to take me 15 or 20 minutes.
We won't react to it. We'll just reflect.
Exactly. And as you're reflecting on it, go to Amazon and buy the book.
Yes. Totally.
So the book is called Capital Allocators, Ted Seides, and this has been spectacular, as I knew it would be. And, thank you so much for being so generous with sharing so many insights from your book. There's still plenty more in there that we didn't get to today. But
Joe, are you going to ask the closing question as well?
I am. I'm just waiting for the perfect opportunity, but thank you, Mike.
Right.
So we always ask this question: would you rather spend a week in the future or a week in the past?
I feel like that's actually easy.
Okay.
Because every week I spend from here on out is a week in the future. So I'll be doing that all the time. So I guess I'd rather go spend a week in the past and change some things up. But as a concept, I imagine I'd rather spend a week in the future.
Excellent.
I like it.
Yeah.
So one last thing, Ted, where can everyone find you? I think we've said it a couple times, but let's give them the rundown on where they can find you and all of the stuffs that you're creating.
Yeah, thanks, Mike. So everything is housed at a website called capitalallocators.com. The podcast is available on any mobile device, Capital Allocators, the book, Capital Allocators. I can repeat myself, Capital Allocators, find something else. We're going to be calling the school Capital Allocators University. The fund will probably be called Capital Allocators Partners. I don't know what it's going to be called. capitalallocators.com, and everything is there. Sign up for our free mailing list there and get this compendium of the book, which is great.
And you're on Twitter? You're on Twitter?
Twitter is T Seides. So that's not Capital Allocators, but there might be a Capital Allocators, so it's not me. Twitter and LinkedIn. So we do put some of those great quotes from every episode on both Twitter and LinkedIn. So anyone's favorite platform, you can get them there.
Perfect.
Fantastic.
Thank you. Thank you so much.
Joe, thanks a lot.
Thank you so much. Appreciate it. Thank you.